Welcome to our comprehensive guide on liquidity-adjusted value at risk, or LVAR. Today, we'll delve into what LVAR is, why it matters, and how to calculate it. Before we dive into LVAR, let's briefly revisit the concept of value at risk, or VaR. VaR is a statistical measure that estimates the maximum potential loss of a portfolio over a given time frame under normal market conditions. Liquidity risk, on the other hand, is the risk arising from the difficulty of buying or selling assets without significantly impacting their prices. In real-world markets, selling large quantities of an asset can move the market price and incur higher costs. This is where liquidity-adjusted VaR, or LVAR, comes in. LVAR incorporates both market risk and liquidity risk to provide a more realistic estimate of potential loss. To calculate LVAR, you start with traditional VaR and then add a liquidity cost component. The liquidity cost is often modeled using a liquidity spread, which reflects how much the price moves due to liquidation. Let's go through an example. Assume we have a portfolio with a one-day 99% VaR of $1 million. This means there is a 1% chance of the portfolio losing more than $1 million in one day. Now, if the liquidity spread for the assets in this portfolio is $200,000, the LVAR would be $1.2 million. Here is how the risk profile changes with and without liquidity adjustment. Notice the significant increase in the risk measure when liquidity risk is considered. Now, let's address some common questions about liquidity-adjusted VaR. Answer: LVAR provides a more comprehensive risk assessment by accounting for both market risk and liquidity risk, offering a more realistic view of potential losses. Answer: the liquidity spread can be derived from historical data, market impact models, or expert judgment. It typically reflects the additional cost incurred when trading large volumes of an asset. Answer: yes. LVAR can be applied to a wide range of asset classes, including equities, fixed income, and derivatives. The key is to appropriately estimate the liquidity spread for each asset class. To summarize, liquidity-adjusted VaR enhances traditional VaR by integrating liquidity risk, offering a more realistic measure of potential losses in volatile and less liquid markets.